If you are a client or a prospect of Oak Harvest, you might wonder what the investment team members do here on weekends, or even on a holiday like Father's Day. This CIO sleeps in until around 6 a.m. on Sunday and wakes up thinking about our clients, the markets, and what's next for the markets. He then sits down over a few cups of coffee with the preliminaries of the Canadian Formula One race on, and he writes what will likely be the talking points for the Oak Harvest outlook for the second half of the year. Before I get into this week's content titled Summer Stall or Summer Squall, please take a moment to click on both the subscribe and notification bells so you'll be alerted when our investment team uploads our latest content. Or better yet, give our team a call here at 877-896-0040 to speak to someone on our team and set up an initial consultation with an Oak Harvest advisor to discuss your financial situation. Frequent viewers and listeners of our content know that our team was quite bullish on the first half of 2023, heading into the year in spite of the ongoing, almost nonstop negative rhetoric on TV and in the financial press. Our first half outlook for the year, penned in December 2022, was titled The Old Normal, and it had a forecast of the S&P 500 trading around 4,300 on the cash S&P when the markets were only trading at around 3,800. Believe it or not, I had payday June 15th and option expiration June 16th circled on my trading calendar for many months with a question mark and a notation labeled Summer Top. It was exactly 8 months from the mid-October 2022 market lows and its pivot higher. Before we get into this week's content, a little year-to-date recap of the 2023 markets and some of its milestones. Folks, the S&P 500 is now up more than 26% from its bear market lows in October of last year. The S&P 500 and the NASDAQ, while still near minus 10% off their all-time highs, have both hit 52-week highs and their highest level since tax day of 2022. After a disastrous performance last year for the markets, in 2023, heading into Father's Day weekend, when this was taped, the S&P 500 was up over 15% on a total return basis, and the tech-heavy NASDAQ was up over 30% year-to-date. The S&P 500 was up close to 2.6% last week, and the NASDAQ was up almost 3.3%. The best weeks they've had since March of this year. The S&P 500 had its fifth positive week in a row, and that's its best since November of 2021 as far as consecutive streaks. The NASDAQ was up 8 weeks in a row, its best winning streak since 2019. So the big question on everyone's mind is, now what? Well, I've got good news and bad news. Or maybe I should reverse that and say I've got bad news and good news. First, it's summer. Historically, our summer slows down in summer as consumers and businesses take a break from their normal activities. With this economic slowdown usually comes a stock market downturn. This is even more likely when the markets are up on a spike and volatility has crashed like they have right now. Take a look at the monthly, weekly, and daily charts in the S&P 500. I've been sharing these for a few months now. Against the backdrop of almost nonstop, bearishly and negatively biased strategist, economist, and billionaire guru commentary, what has happened? The stock markets have made a series of higher highs and higher lows. So are you like many investors who recently tuned into financial news and are now experiencing FOMO? That's fear of missing out. Are you now being swayed by billionaire boasts of those retired fame hedge fund billionaire legendary managers like Ray Dalio that say now is the time to buy stocks on June 12th after 800 points up in the S&P 500 in 8 months? That same retired legend who deemed cash is trash multiple times the last 5 years, only to have the market plunge minus 10 to minus 25% the next month or two, including the COVID crash, who reversed course and deemed cash is not trash on October 3rd of 2022 within a day and a few points of the cash S&P 500 making its closing low for the last 24 months? If so, please do yourself a favor and do your money a favor. Turn off the news, take a deep breath, and keep on watching this video. Relax. You most likely have time. Yes, investors, according to Merrill Lynch, statistically speaking, the S&P 500 just entered its 27th bull market of 20% or more on June 8th. Having missed the 8-month rally in stocks, do you need to panic right now and buy them? No. However, yes, the data is promising for the next 12 months. Going back to 1929, cyclical bull markets like this have lasted over 33 months on average, with an average return over 100%. The year after the S&P 500 enters a cyclical bull market shows the index higher 65% of the time, with an average return of about 9.4% and a median return of over 14%. These returns would equate to around 4,700 on the S&P 500 and maybe even 4,900 in June of 2024. For what it's worth, my model has the S&P returning to the level of 4,700 later this year after a summer stall and a sell-off. As for 2024, I don't know yet. I can come up with even much higher numbers in bullish outcomes than 4,900, as well as wildly bearish lower levels from here. Let's see what the second half of 2023 holds first. It's summertime, and it's time for the markets to rest. The cash S&P 500 peaked at essentially 44.25, 44.50 last week. Believe it or not, this was my calculation I had the index reaching based on my volatility model into the first half summer peak under the most optimistic unpublished case way back in December of 2022. So what's next? What's likely after an 8-month run-up? Well, more often than not, the markets take 2 to 4 months to digest these gains. Not days or weeks, but months. It's very normal to see a 4 to 5% move down over the next 2 months, followed by another 2 months of bouncing around. Let's call it minus 200 to minus 250 points down in the S&P 500. This would take the markets back to where they were just in late April. S&P 500 around 4,200, 4,175. This level also happens to be where the POWELL PUKE in August of 2022 happened. You can see all these levels on the charts earlier in my video. But Chris, you usually present data to support your outlooks. Where's that data? Here it is, compiled by the group at Merrill Lynch. Focus your attention on the column heading, 250-day return, which equates to roughly a 12-month period of trading days. For those of you who have made it through this video, that's a sneak peek of what our team thinks might be in store for the rest of 2023. For now, we're thinking down back to 4,200 or slightly lower over the next 2 months into mid-August, bouncing around into late third quarter, then a strong year-end rally back toward, but just short of all-time highs for the overall S&P 500. While summer is a normal time for investors to get away from their screens and focus their attention on fun and family, I would suggest you take the recent run-up in markets and crash in volatility to get on the phone and give us a call at Oak Harvest. Set up an initial consultation with an Oak Harvest advisor, or if you're an existing client, schedule a review of your financial plan, your goals and objectives, and your asset allocation. Now is the time to review your goals and objectives, not when things are whipping back and forth, up and down quite quickly in the markets. If you're having thoughts like, I need more growth in my portfolio, or I need more income in my portfolio, making those asset allocation actions are best done when the markets are calm. But investors, remember, there are no guarantees in the markets. You can't just turn on more growth or turn on more income in the stock market. That's not how they work. The exact path forward is always uncertain. Making asset allocation decisions in your portfolio, be it stock or bond mix or equity style changes, are best made when markets are calm and emotions are running low. Making emotional decisions when markets are volatile and when we're feeling highs and lows as an investor is the wrong way to invest in my book. At Oak Harvest, we have many tools that our advisors use to help our clients meet their retirement goals and objectives. Some of these tools are market-based, some are insurance-based. We think we can use both to meet your retirement goals. The future in the stock markets are always uncertain. That's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. For myself, the rest of the investment team, from Troy and Jessica and everyone else, have a blessed weekend.